it's me again, Virginia, and again with Marcos. You know, the 1031 exchange expert. Yeah, something very important. We had a very short introduction. Somebody told me, no, I'm going to do the 1031 exchange later. And they put the money from the closing into their checking account. And then I go, no, you should have contacted the experts before, because if you touch the money from the sale, what's going to happen?
Oh, yeah. So very good. So we need to understand when and why the 1031 exchange happens. The 1031 exchange is a tax deferral strategy. It's an allowance that has been given to us since 105 years ago.
Oh, it's already 105? I was on the 100, but okay,
105 years old. When you own investment property, it's different than owning a primary residence.
Of course.
Right? Because you're creating income. So it's a business, right?
Yeah.
When you sell that property, if you were to just sell it, you get hit with major capital gains. The capital gain is the difference from when you purchase it to when you sell it later. Has nothing to do with equity, has nothing to do with proceeds. It has all to do with the difference in what you purchased it for and what you pay for later. Of course, some other things that factor in.
But in general.
That's basically it.
Yeah.
So let's take a look at a property that was purchased for like $500,000. And in 15 years' time, they sell for $1.5 million. Okay. That original purchase price is called the basis. It's fancy language for the original purchase price, adjusted to include depreciation, subtract depreciation and capital improvements. So the gain in that difference is 1.5 million. You subtract the basis, the original purchase price, 500. That's $1 million gain. Okay, that $1 million gain would be taxed.
Yeah, that could go up to
the 35 to 40%.
It's a chunk of money.
It's a chunk of money.
40% in $1 million. We're speaking about $400,000. It's almost close to $500,000.
Yes. When you break down what you would pay the IRS, what you would pay the state of California, and then there's also another tax that was created in our lifetime, the 3.8 Obamacare, which is the Medicare, which is still intact. But then there's another tax that comes off of the top. It's the depreciation recapture tax. So you must take a depreciation, for wear and tear and for upkeep of the property. And so it accumulates over the lifetime that you're given by the IRS, 27.5 years for the residential, 39 years for the commercial. So if you were to sell it, and let's say you've paid that allowance, those 15 years, you would have to pay 25% of that in addition to the gain. So leaving you with only 60% of that $1 million gain to reinvest. The rest, upwards of like $300,000 to $400,000 would go to Uncle Sam.
Yeah.
So that's why people do the 1031 exchange.
So what would be idea? Well, I know what it is, but I wanted you to explain. So people own a duplex, a triplex, or a fourplex, and they want to sell because, they want more doors.
Sure, they want to open more doors, right? So they could go from a duplex and exchange into
10 units.
10 units.
Yeah.
Or they could exchange into two nice beachfront single-family residences. You can go from anything. So there are four main rules to the 1031 exchange. First, they must be like-kind property. Now, people confuse this with identical property. But like you just mentioned, it's just how that property is going to be used. If you're using a duplex for rental, you can buy anything that is, in terms of real property, that is also going to be used for business or investment purposes. That's rule number one. The second one is whatever you sell for, you must replace for at the same value or greater. So the sale price on the relinquished property must be brought back at equal or greater in the replacement
So
property.
right now we were
Or
speaking
properties.
about, the property that we were gonna sell. Right now the value is 1.5 million.
Property. The third rule is the tax structure. This is really, really important. The tax structure and the taxpayer titled on the relinquished property must be the same taxpayer and tax structure title on the replacement property. So John Smith taxpayer must be John Smith taxpayer who purchases the replacement
Yeah, you
property.
cannot add.
You cannot add anybody. You cannot change the tax structure because that causes problems.
Yeah.
And then the fourth is adhere to a very strict timeline. Like you were mentioning, the exchange starts when you go into escrow for the relinquished property, because at the close, that timeline starts, and it's 180 calendar days.
Yeah, no
Weekends and holidays
business, no
down,
business
right.
day, just
And the first
calendar.
45 days are for identifying the property or properties that you want to go. But like you mentioned, a very good thing.
Yeah.
People think that if you leave the money in escrow,
then
then you do it. No, the IRS sees that as constructively received funds and are taxable.
and you're done. Okay, well, hope you got good information. Hope you call us. Any more questions? Marcos offers great information, flyers that I can also email you or mail out to you. Call me 323-717-5167. Here, Marcos Jacks. Thank you.
you.
Have a good day. Bye.